Hello, I am Prashant Kothari, Portfolio Manager of the Pictet Indian Equities Strategy. In today's video, I would like to address the recent performance of the Indian equity markets, share our outlook for the near term, as well as providing you with a brief recap of the Indian equity strategy that we manage here at Pictet. Since last September, the Indian equity markets has experienced a notable correction, making investors nervous about the asset class. The obvious question is it a bump in the road or is the Indian equity story broken? Let us first try to understand what has changed. 1. Economic growth has moderated. 2. Geopolitical uncertainty and concerns around tariffs have resulted into a strong US dollar, impacting Indian currency. 3. Foreign institutional investors have been significant net sellers, withdrawing about $25 billion in Indian equities since then. In addition to this, corporate earnings have also played a role in dampening investor sentiment as the margin upcycle seems to be plateauing now. While domestic measures such as tax cuts were announced in the latest Indian budget and there is strong support from the RBI, this has not been sufficient to offset these headwinds. In particular, small and mid-cap stocks have borne the brunt of this correction, with indices falling about 20% since September. Regular listeners would recall how we have been cautious about the mid-cap space, and that has exactly played out now. While understanding what has changed, we feel it is also important, rather more important, to know what has not. Jeff Bezos, who is the founder of Amazon, said it the best. I very frequently get the question, what is going to change in the next 10 years? And that is a very interesting question. It's a very common one. I almost never get the question, what's not going to change in the next 10 years? And I submit to you that the second question is actually the more important of the two, because you can build a business strategy around the things that are stable in time. The same holds true for investment strategies too. Ultimately, what makes India a compelling investment remains unchanged. India's robust demographics, progressive policy making, a strong institutional framework, and a high-quality corporate sector continue to provide solid foundation for growth. Moreover, some things have actually improved. The exuberance seen towards the middle of last year has subsided, leading to more reasonable valuations, offering a healthier market environment for investors. Historically, foreign investors have only been net sellers of Indian equities in 4 years over this century. We are also already starting to see some tapering off of these outflows, with the potential return of foreign investors serving as a robust catalyst for the market to recover. A lighter positioning of foreign investors is a good starting point for future returns. GDP has also recovered in December quarter to 6.2% from 5.6% in September quarter, driven by a recovery in private consumption and government expenditure. And the recent decline in inflation in January has opened up more scope for the Reserve Bank of India to lower interest rates, with the next move expected in April. India's commitment to economic reforms and expanding trade partnerships, for example, positions India not only as an emerging market leader, but also as a cornerstone of the global investment landscape. Looking ahead, economic growth in India is expected to outpace other major economies in 2025. And what makes India unique is that India's ascent is domestically fueled rather than being export-driven or externally driven. This combination provides both resilience and long-term upside, with the theme of financial inclusion and increased participation through systematic investment plans, helping to boost market stability. Corporate earnings are still expected to compound in double digits for the years going forward, and that will provide a strong reason for the Indian stocks to provide high returns. As investors, we are students of financial history. Equity markets are volatile and can suffer corrections. Indian markets are down about 20% in the past 6 months. To help put the market environment in perspective, we went back over the last 25 years and checked all the times when the markets declined significantly. In many cases, we saw a recovery 1 year after a correction, and in all cases, a positive return was observed in the 3 years period after that. What do we learn from that? Simply that patience is crucial. Charlie Munger famously said, "The big money is made not in the buying and selling, but in the waiting." Particularly during times of uncertainty, a disciplined and long-term approach is more important than ever. Let's take a moment to recap our investment philosophy as well. We invest in high-quality businesses in India with a long-term mindset and discipline on valuations. That often means being slightly contrarian. We appreciate the value of downside protection, something that investors often overlook during exuberance. When liquidity-driven rallies push valuations beyond fundamentals, we step back. When fear creates mispricing, we step in. This is why our approach has consistently delivered not just alpha, but true risk-adjusted performance, as seen by the fact that our strategy has generated alpha in more than 70% of down months over the last decade. The current pullback offers attractive entry point for investors like us that are seeking good quality companies at reasonable prices. We are striving to leverage our deep understanding of the Indian corporate sector with a focused and disciplined long-term approach and willingness to make contrarian decisions. Short-term volatility is inevitable. After all, it is part of investing, but it does not alter the broader trajectory of the Indian equity market and the immense potential that can be captured by investing in this compelling market going forward. India's structural growth story does and will continue to offer opportunities for those ready to seize them. After all, we must invest in the present to earn in the future, as said by the chairman of Wipro, Ajim Premji. Thank you very much for listening.